Well, welcome back to another episode of the Wise Wealth Podcast with myself, Josh, and Sean Humphreys, episode number 28. In this episode, we are going to jump into I guess we're also going to talk about our visual capitalist side of the day, but there's two main segments we want to touch on. Number one, Sean's going to talk about coaching in retirement. So often when we get to retirement, I wouldn't know, I'm not in retirement, but for most people, there's a lot of emphasis on the financial modeling and the numbers and making sure all our cash flow needs are taken care of and our expenses are integrated into our modeling. And there's a big emphasis on the numbers, but research is showing that most of the value and a lot of the value of the planning and retirement is the non-financial aspects of retirement. So I know he's got a bunch of great academic content on that. And then I'm going to talk about, there's this paper in 2021 called Best Ideas. If you've been listening to the podcast for a little bit, you probably know where Sean and I land in terms of our investment philosophy. We haven't been, I guess we've been relatively explicit, not super explicit, but there's this paper that came out that it doesn't contradict what we've been arguing, but it adds I think some nuance to the idea of the index passive investment type of investment philosophy versus active management. And it's basically arguing that there's a lot of value that active managers add, but the value doesn't come to the end investor, but their highest conviction picks in these funds do really well. It gets diluted. I'm just ruining my whole thing I'm going to talk about, but I think it's going to be super fascinating. The paper's called Best Ideas. So yeah, Sean, what's the visual capitalist side for today?
We're going to talk about what the visual capitalist we're going to cover today is household debt levels and how various countries stack up relative to each other. And, debt's kind of a controversial area. I'll share a few thoughts on it, but the first thing we'll do is we'll just take a look at, where's Canada relative to all the different countries around the world? Maybe some of the reasons why some countries are higher from a debt standpoint than others. And so it's kind of an interesting perspective. And for all of you watching, love to hear your perspective on debt. Is it good? Is it bad? Are there situations in retirement, particularly where carrying debt maybe makes sense? So we'll take a look at that. So first of all, let's just take a look at the visual capitalist image. So let's take a look at, how countries stack up. And interestingly, the Swiss have the highest household debt per capita around the world, really high. And there's a little comment here by the folks that put together this infographic. Swiss household debt is high partly because its mortgage system encourages borrowers to never fully repay home loans. And I don't think that that's, necessarily unique just to Switzerland. They have their own maybe system around how people handle household debt. But you have other countries around the world where housing costs are very, very high. And so just having a mortgage and household debt that just allows you to be into, a home is just part of life. I mean, you just take on a mortgage and you're always going to have a mortgage. Total household debt, though, can be concerning because it's not just mortgage debt, which you could argue maybe there's some good qualities around that, right? You're buying an appreciating asset. Hopefully it's going to grow for you over time. But then you've got debt that gets accrued and grows because of consumer spending, which is not a great thing. Now, if you go down this listing, again, some of these countries might be surprising. Luxembourg, Norway, very wealthy countries. And then you get down to the US. So we're talking, within the top 10. You can kind of understand the US. Partly it might be inequality, where maybe sometimes people taking on more consumer debt just because of cash flow restraints. In the US as well, you can deduct interest costs on your mortgage. So that can incentivize the population to take on more debt for that purpose. You can't say the same thing of Canada. And Canada's like right behind the US. And so it's a little bit concerning that our debt levels are so high. There's no incentives, at least at the personal level. At the business level, of course, you can write off interest costs, but on debt if it's attached to the business. But for consumer spending, you can't. And so you see Canada fairly high in the overall ecosystem of this listing. You go down, Germany relatively low, Israel, keep going down this listing. Saudi Arabia, flowing with lots of oil. Maybe that's the reason why their debt levels are low. And then China is one of the lowest. So here's a question for you. Number one, what's your feeling about debt generally? Are there times where taking on debt is good and times when it's absolutely bad? What do you think about debt being taken on by people transitioning into retirement? Does debt make sense, do you think, from a business standpoint, taking on debt to grow a business, or are you against that? what do you think the generalized approach to debt should be? So again, as a country, we're pretty high. And one of the concerns, obviously, that we've been talking about as we go through the visual capitalist infographics is in Canada, our economic situation's not great. There's price inflation, generalized inflation, families are crunched. On top of that, we also have obviously high levels of debt. And here's the last question. What do you think of the idea of actually making interest costs on home mortgages tax deductible? Do you think that's a good thing or a bad thing? So that's this week's infographic, Josh.
It's good. I was gonna say where do the people watching, like, where on the spectrum of Dave Ramsey to Robert Kiyosaki,
Yeah.
Rich Dad Poor Dad? He loves debt. Dave Ramsey, not so much. Where in that spectrum do you fall? Yeah, that's good. It's fascinating to see all the differences in countries in terms of debt levels. Okay, do you want to jump
Yeah,
into your?
I'll jump into my presentation. I'll show my hand. Like I think business people taking on smart debt, you can write it off. Real estate, you have to be smart about it. You want to be overpaying in a peak market, taking on a ton of debt. But I think there's a useful application of leverage in the right business situations to lever up opportunities for sure. But you got to
Mhm,
be smart.
absolutely.
Yeah, let's talk about the next topic. And you did a great introduction, and that was the whole idea of like this coaching idea. We often think that we do coaching for clients, but a lot of the work that we do is financial coaching. But I came across some information recently that kind of inspired me to sort of just reflect on some really important areas around the aspect of planning for retirement that's not just related to money.
Yeah.
So when I was doing a little bit of, reflection on this topic, here is some basic information that informs the discussion a little bit. I've had the privilege of going through actually retirement coaching programs just to sort of be a continuing education piece that I've been sort of working through. And when you start going through the data, it's actually shocking some of the adverse outcomes from a health standpoint that many retirees are experiencing. Higher numbers than you would expect in terms of depression, drug and alcohol abuse, and poor health outcomes in many different areas. And you kind of go like, why is that happening? Like you transition into a time in your life when you've got total flexibility, you can handle your schedule the way you want to. And for the first time in life, you're not having to be accountable necessarily to at least an employer or your business or employees and all those kinds of things. So it's all about golfing and traveling in this next phase. Is it really that? Well, the data says that that's not really what happens. So we get through this honeymoon period, and then the reality of life begins to kick in. So if you look at folks that specialize in the coaching area of retirement, what they'll tell you is that retirement planning outcomes are shaped really by behavioral and life design variables, which is kind of interesting, not just financial assets and financial planning. So what you tend to see is that for a lot of people planning for retirement who are serious about the topic and lean into it, they're doing a pretty good job on the technical aspects of planning. Everyone needs to tweak and, adjust and keep their plan up to date, but they're doing a pretty good job around the financial aspects of their planning. But what they're not doing a very good job is operationalizing the freedom that they have as they go into retirement. So they have this freedom and they're having a difficult time superimposing on top of that freedom a little bit of structure, a little bit of connection, and a little bit of contribution, giving back to the community. And so there's this disconnect between the financial aspects of their planning, how they're handling this newfound freedom in their schedule. And a lot of people are just sort of casting adrift. They're not really connecting. They have no structure, and that's leading to low grade anxiety and depression. So what's the solution? Well, the solution is a structured process to translate intention into a workable weekly operational model that holds up as life evolves. In other words, what are you doing around your finances? What are you doing to make sure that your overall experience of retirement is as exciting and uplifting as you hoped it would be as you begin to plan for that transition? So I'm going to cover off, first of all, some basic sort of warning signs that you may want to look for. If some of these warning signs begin to percolate in your life, then you may want to give consideration to speaking with a retirement coach, even a psychologist around how do you deal with some of these issues? How do you sort of reframe your retirement transition to take into account these other issues that can get in the way of you having a great retirement, even when you've looked after the financial aspects pretty well. So what we have here is trigger events. So moments when the transition and the coaching need becomes visible. You're beginning to think, maybe I need to talk to someone about this. So one is you're retiring within the next 12 to 36 months. I think it's a good idea to talk to someone about the softer facts of retirement planning. What are you going to do with your time? What's your spouse going to do with their time? And so what's the connection between those things? How are you going to cultivate purpose and meaning? There's some things that you can do obviously prior to retirement that if you're intentional, you can start getting the runway ready for that transition. Are you considering your recently retired initial wave of freedoms begin to wear off? So this happens to a lot of people. So they move from a structured environment to an unstructured environment. And all of a sudden they get to a point where that sort of honeymoon period is beginning to phase out and they haven't prepared now for the next phase of the retirement. We're becoming a little more structured and intentional in your schedule is important. So that might be a bit of a trigger event. Trigger event 3, considering phased retirement consulting or a second act. I've seen this work really, really well for a lot of people. And so as you look at the retirement, they're maybe beginning to transition not to full retirement, but a different career. And it's sometimes really good to have a retirement coach help with that. Number 4, a trigger event could be major relocation or downsizing decision is on the horizon. All kinds of psychological and emotional factors come into that one. And again, there could be some great utility in having someone walk you through the trade-off decisions around that. Number 5, rising caregiver demands or a meaningful household health change, right? So we see this in our practice. It's prevalent in the literature and the research out there how adult children, grandchildren are not only becoming a pretty important part of, retirees' lives, but there's also not just the time suck, but also financial needs that these families have in the midst of a cost of living crisis. So how do you negotiate around that? And the reality is we did a video recently and, if you retire at 65, the Stats Canada data says that you can have a healthy life expectancy, healthy life, right? You might live to age 80, but 85, but your healthy life expectancy runway might be age 67, 2 years, right? So the practical reality is health issues can get in the way. And again, some coaching through that can be really helpful. And then you're entering retirement at a different time or pace than your partner. That's a huge one. So renegotiating your relationship and trying to figure out how you can find a happy medium between you and your partner around what this retirement transition looks like. The 6 friction signals, phrases and, the patterns that flag a need beyond financial planning. Here's some things that you can begin thinking about a little bit. So, is there a lack of excitement in the transition? Are you feeling like you're not relevant, that people are looking past you? They're not, seeking your advice anymore. And that's creating a little bit of, unhappiness, low-grade depression. Too much freedom. Days feel unshaped. Momentum and engagement are declining. Decision fog, postponing decisions, choices, circling options, fear of committing to a path. And weak follow through, strong stated intentions, but consistent failure to act, and then relationship strain. So these are some of the friction signals that you may want to be mindful of as you begin thinking about retirement, and maybe in retirement, you're experiencing some of these things. So the financial planning aspect, totally important. It's a critical aspect, but the sort of softer aspects of retirement in terms of your schedule, your sense of contribution, your relationships, your health, all those conspire very strongly to generating the experience of a great retirement when those areas are attended to with the same intentionality that you're doing with your finances. So that's my perspective, Josh, on retirement coaching, some of the trigger events and some of the background noise that sometimes happens for people. And we just don't take it seriously. It's Freedom 55, it's happiness and golf and travel. That's a small percentage of the retirement experience. And so what are you doing with the other 80% or 90% of your time?
Yeah, I use the term life design. I think it's just so important to think about what that means because the financial aspect and like making sure you're secure is just one aspect of that life design, right? There's all these other things like what is your meaning now that you've moved on, presumably from your career, right? So what's your purpose? Like, why do you get up in the morning? Is it just the golf or is it, I mean, maybe you want to pursue golf professionally as a senior. I don't know. Maybe that could be there could be some meaning there. I might try to do that.
Yeah, well,
But yeah,
and I wouldn't say this is the norm, but I've had experience over the years where people have retired and they didn't properly prepare for this aspect. I certainly would say that for most financial planners like us, it's not the first part of the conversation we're going to have, right? Where we drill down into the financial aspects. And there's an increasing awareness that, yeah, that's important. But, if I look back, I've got clients, typically males, who retired from pretty senior positions and they ended up hiding in their basements for years.
yeah,
And it was a huge head fake for them because they went from an environment where people asked their opinion. They were in leadership roles. They were giving direction. They were getting attaboys and pats on the back all the time. And then they made this transition and they didn't prepare for what I'm going to do. What am I going to do in the next phase to get that sense of meaning, purpose, even recognition? What's my identity? And it just dissipated super quickly. And you have to have a certain level of humility through this transition, right? If you're functioning at this level in an organization, you may not be functioning at the same level in your new reality. And so that humility needs to sort of, manifest itself. So you're going, I'm okay with doing such and such for the local church down the street in terms of volunteer work. I don't have to be the big dog anymore, but I do want to make a contribution using the skills that I have. And
yeah,
sometimes ego, right? It gets in the way of people making those transitions and it just makes things worse. It's kind of interesting.
yeah, absolutely. Awesome. All right, let us know your thoughts down below. Let's move on to part 2 of this episode. So when I was doing some reading, I found this paper. Actually, I originally found it on LinkedIn, and the paper is called Best Ideas. So the whole premise of the paper, there's this big debate in investing about whether or not active management on the portfolio, stock picking, timing the market adds value net of fees. A lot of the research is arguing that they don't add value net of fees. They might add value and outperform the market, but because they're outperforming the market, they want to be compensated as such, which is fair. If you're doing a hard job, you're doing it well, you want to be compensated for it. But then the end investor ends up underperforming the market. So these researchers out of Harvard, London School of Economics, IESE School of Business, I think that's out of Spain, or yeah, I think it's somewhere in Spain, thought the framing that active management just doesn't provide any value is too blunt, and there's a little bit of nuance there. So they asked the question, what if the problem isn't that managers lack skill, but that the structure of the industry kind of prevents them from acting on that skill fully? So it's not whether or not active managers can beat the market, it's whether the funds or the way the funds are built and sold systematically buries whatever skill those managers actually have. So Anton, Cohen, and Holk, the researchers in the paper, studied U.S. active mutual fund holdings from 1983 to 2019, so many years of quarterly data. They excluded index funds and any fund really that didn't meet their criteria of funds focusing on genuinely trying to outperform. And their core question was, if you could identify each stock or position that a manager really believed in, their highest conviction position, how would that stock actually perform? Right? Often when you're in these lunch and learns that us as advisors are in, and we're being pitched on these funds, there are a few holdings in the fund that the portfolio managers are really, really excited about. And then there's a lot of holdings that they don't talk about that the fund has, and those are also in the fund, but they dilute the high conviction holdings. So the question is, how did these researchers identify the high conviction holdings? So they didn't just survey the managers, they reverse engineered conviction from the portfolio itself. So if a manager holds a stock at a meaningfully higher weight than its market weight in a market cap portfolio, especially in a volatile stock where the bet is hard to disguise, that overweight signals genuine belief. They calculated an implied information ratio from every position in every fund, which was a measure of how much the manager appeared to believe in each holding relative to its risk. And then the positions with the highest implied ratio were labeled as the manager's best ideas. They then assembled a portfolio of all the manager's best ideas, rebalanced quarterly, and then tracked it forward. They tracked it over that roughly 35, 36-year period. So what did they find? Well, the highest conviction positions outperformed risk-adjusted benchmarks by 2.8 to 4.5% per year. Now, if you think about the average fee on most active management funds, they're probably around 1.5%, the MER on a lot of them, somewhere around there, right? So if they're outperforming, if the highest conviction positions are outperforming by 4.5% on the high end, obviously that kind of justifies a 1.5 to even 2% fee on the fund. They found that the outperformance did not fade. Buy and hold abnormal returns on the best idea portfolios accumulated to roughly 20% over 10 years with no reversion, suggesting the stocks were genuinely mispriced. At purchase, the rest of the portfolio, this is really important, the rest of the portfolio, all the other holdings surrounding those top picks generated a 6-factor alpha of 6 basis points per month. So it's basically nothing. So 6-factor alpha means that what's left over after controlling for exposures to factors like market risk, size, value, profitability, investment of the company itself, and then momentum. So if the alpha is 0, the returns are fully explained by those factors. There's no skill. So basically what they found in simpler terms, that the positions of the managers held with low conviction had low returns, basically indistinguishable from 0. So what's that? What they're arguing there is that the high conviction had really great returns, and low conviction that were in the same fund did nothing. And they really diluted the returns of the fund. The researchers then ranked every manager's holding from 1 through 10 by implied conviction. The first 5 positions showed significant outperformance, and then alpha declined steadily with each step down the list. By position 6 through 10, the effect of outperformance largely disappeared. There's another paper from 2009 that showed when multiple funds belonging to the same fund company trade the same stock in the same direction, that stock outperforms. So it just shows that like when a company really believes in a position, or a bunch of portfolio managers really believe in a position, and their actions back that up, it often outperforms. We'll get into why funds don't actually just go all in on these high conviction positions in a second. But in a similar vein, hedge funds, small hedge funds under 100 million in equities, posted 58 basis points per month in risk-adjusted excess return on best ideas. And then the larger companies, those over 10 billion, posted negative percentage point estimates. The gap between small and large was more than 1.26% per month. This was demonstrating basically that as funds get larger, it becomes increasingly difficult to find ways to outperform. We see this with, I'm blanking on the name, Renaissance Technologies. They had this fund, is it the Medallion Fund? It was a private fund for employees. And they were getting like 66% gross returns before fees per year. And everyone wanted in. No one really knew how they were generating these insane performances or insane returns. And basically they didn't allow anyone in because whatever strategy they were implementing, as they scaled, it became harder and harder to generate these returns. Because as you get bigger, you move the market, right? As you go all in on a certain position, it can bring the price back to some sort of efficient pricing. Anyways, fascinating stuff. And then, so the obvious question is, why are managers not simply acting on their best ideas and going and having concentrated positions in those best ideas? Why are they adding all these other positions in these funds that dilute the performances? So, number one, regulation. So regulations force diversification. In Canada, mutual funds are governed by regulation, which limits the exposure to any single issuer to roughly 10% of NAV, net asset value. So even without hitting a hard regulatory limit, there's liability and those problems. So a diversified fund that underperforms reads as bad luck, right? A concentrated fund that underperforms often looks like they made a mistake. And mistakes by funds attract regulatory attention and investor complaints, right? So when they're diversified and they underperform, well, it's less of a problem. Additionally, institutional fund selectors explicitly prefer funds with low idiosyncratic risk. Idiosyncratic risk is firm-specific risk, right? When you diversify, you can reduce firm-specific risk, and then you'll have obviously systematic risk or market risk. So when you're really diversified, you can reduce idiosyncratic risk, and obviously institutional investors or those selecting funds prefer that to be low, right? When you're concentrated, you have high idiosyncratic risk. Number two, the fee model of active managed funds reward asset gathering, not necessarily alpha. So Canadian mutual funds are primarily sold on a management MER, a fixed percentage of assets under management. A manager's paid more when the fund is bigger, regardless of whether the fund performance justifies the size. So genuine alpha from any single idea is finite. A manager's own buying pressure eventually moves the price towards fair market value. That's one of the problems with scale. So to keep absorbing new investor capital, they have to deploy it somewhere else and add positions. And often those additional positions have lower conviction. This is where you get into this problem of a lot of funds being closet index funds, where they kind of have their high conviction and then they do similar things to index funds. So they overlap in what the index would be doing. So you're paying high fees for a closeted index. Growing the fund serves the manager's income. Concentration in best ideas serves the investor's returns. So there's some structural conflicts of interest there. And one of the key conflicts of the paper services, so the incentive to gather assets forces the manager to hold stocks they might not believe in at the same level that they believe in their top picks. And then those extra positions dilute the alpha to near zero for the investor at the end point. So that's kind of like the main thesis of this whole idea, or this whole paper. They're basically arguing that like managers should go more all in their best ideas, but they're probably not going to do that because the incentives are just not there. Number 3, managers are protecting their careers and not your portfolio often. Again, this isn't really a shot at managers. This is what their incentives are propping them up to do. Like these are human beings. They got to support their family, right? They gotta not destroy the funds that they're managing. So a manager's personal financial situation is completely different from their investors. Obviously, a Canadian investor holds diversified income sources. So CPP, OIS, they have TFSAs, RSPs, workplace pensions, right? A single fund, concentrated fund is just one line item to them. But for the manager, the fund is their career. A concentrated losing streak does not hurt returns. It can often end their jobs. So there's a lot of risk there. And sometimes the potential benefit, it doesn't justify taking on all that risk. And so the researchers of this paper make it clear it's not necessarily dishonesty on the manager's side, but they're responding to real incentives. But the last reason why there isn't a full concentrated position on their highest conviction picks is because rating systems like Morningstar's rating pushes concentration to the funds that are rated very highly. So Morningstar's rating, the most widely used fund selection tool in Canada and the US, are built heavily using the Sharpe ratio. So return per unit of volatility. And the Sharpe ratio penalizes any fund that delivers returns through a concentrated volatile portfolio, even when those returns are exceptional. So a diversified fund with mediocre but smooth returns scores a little bit better than a concentrated fund with strong but bumpy returns. So research shows that Morningstar's rating is the single strongest predictor of a fund flow. So money that flows into the fund, if it's rated highly on Morningstar's rating system, investors see that and then they want to push their money, or advisors even want to push their money into that specific fund. So the products most likely to express genuine manager conviction are also the products that are least likely to survive commercially. That's a tough pill there. Fund companies know this, so they build products optimized for ratings, right? So they have all these other holdings that they're maybe not super pumped about. They're optimized for ratings, not alpha generation. And the system produces what investors select for, and investors guided by ratings select for low volatility. Often people are really nervous about volatility. So yeah, that's kind of basically all I got. I mean, for retirees and retail investors, it's likely that they're paying, when they're buying these active funds, they're paying high fees for near index exposure, right? The fee drag is really an important component to think about. And yeah, I don't know, Sean, if you have any thoughts on that.
No, I think it's a good overview. A lot there, but I think to
Yeah.
summarize, like you said, it's like if you've got conviction about almost anything in life, you're probably going to do a little bit better at it. And it's interesting that manifests itself in the investment management space. You see small companies getting started by entrepreneurs. They can pivot, they can move very quickly. It's all about getting that company established and growing. You could apply the same thing to a new money manager. And so they're able to pivot. They have less at risk, so to speak, because in the early formation stages of building their firm, as it gets larger, now they're getting more concerned about risk management and the downside. What
Yeah.
can I do to preserve this? Which means that they're now not pursuing the strategies that led to growth in the first place. So here's a question for you. So knowing all that, how does this research apply relative to our philosophy, which is we believe in the pricing machine of the markets,
Hmm.
that you really can't beat the market over the longer term. So how do you put that belief beside what you just talked about in terms of conviction? Are you saying that, hey, if you can just find a manager with strong conviction, that's going to beat a broad olive market portfolio over the longer term? Or are you just saying that, just saying simply active doesn't add value, there's some nuance to that, and there may be some aspects that could add
Yeah.
value?
Well, I think fundamentally there's this I think false idea that like active managers add no value, right? They add value. We can even see that in private markets, right? There's private market managers of like private credit funds or PE funds that do really well, but then they want to be compensated for their skill. And so for the end investor, they're underperforming a broad market index benchmark because of these fees. So I don't think the research is, I mean, if you found a portfolio manager who's like all in on their highest conviction picks, maybe, but even then, I wouldn't. I think the structural issues of these funds is the real problem, that they're not incentivized to go all in. Also, the volatility, I think most people wouldn't be able to stomach for these type of positions, these high concentrated positions on a few
Yeah.
stocks.
Yeah.
Um,
Yeah.
how do you
Like,
know you're gonna pick? Like, how do you predict which manager, right? Because obviously, on average, they were outperforming, but how do you predict which manager is going to be in the part of the spectrum that outperforms? And I don't know. I think the main point that they're making is, theoretically, if they went all in, on average, the active managers would outperform, but they don't do that, right? They have all these other holdings which dilute it, which means for most investors, like it doesn't make any sense to move to active management.
yeah, well, I think these incentives around, these managers and whatever you do has a huge impact. I mean, as you're talking about this, it makes me think of, I did a video years ago about Peter Lynch, who money manager with Fidelity Investments. He managed a globally diversified, balanced fund that was the top fund for, 10, 15 years. The performance numbers on that portfolio was absolutely mind blowing.
Yeah,
And the majority of unit holders that bought that mutual fund lost money
yeah,
because they couldn't stomach the volatility. So if you just put your money in the Magellan Fund and let Peter Lynch do his thing, at the end of the 5 years, 10 years, 15 years, you had absolutely amazing performance. But he also believed in something called the 10 bagger approach to investing. If you read some of his work, right? Take your 10 best ideas you have lots of conviction on, and put them in the portfolio. All you need is one stock to do really, really well, and you could have the other nine stock be mediocre or lose money,
yeah,
and you could do well. Very, very aggressive, high conviction trading style that did extremely well. But most unit holders that bought his portfolio couldn't stomach the volatility, right? So,
yeah.
that was a huge issue. So anything else, Josh, to add to that commentary on that study?
No, I think it's just fascinating. There's so much more nuance in this. Sometimes I think I've heard people who are in the boglehead area of this conversation just kind of crap on active management, because I mean, you look at things like the Spiva report and stuff like that every year, and they're just underperforming, and they're charging high fees. But I think the fees are really the problem. Like there's clear value that they're creating. It's just not value that's actually getting to the end investor, which is fundamentally the problem. Because if you're an investor, like, why would you? Maybe you're just excited to talk about the fund and you want to support your fund manager's retirement by paying them high fees, but then you're just donating. Like, you're not getting any real value.
Yeah.
Anyways,
Yeah. No, exactly.
um,
Well, that's good. So hopefully those of you that have stuck with us this long, if you have any feedback on Josh's comments, it would be great. Any feedback on debt levels, particularly debt levels in Canada? Do you think it's a good idea to make interest costs on mortgages in Canada tax deductible? Pro, con, love to get your feedback on that. And if you want some resources, complementary resources on, retirement income planning, make sure you go to the website. There's a link
yeah,
back to the website and you can poke around there.
Awesome. All right. Thanks so much for watching. Make sure to let us know your thoughts, like the video, subscribe, and we'll catch you in the next episode. Take care. Bye-bye.